G'day folks, welcome back to another update for gold and silver. Now long term we're still bullish on the charts, but shorter term it's in a bit of a downtrend, so we're just going to be cautious about that. We'll include some back testing, and don't forget to hit that like and subscribe button to support the channel. In terms of the outlook as of today, 1st of May, gold price have surged approximately 25% year to date, reaching around 3,300 per ounce, driven by central bank purchases, de-dollarization and recession fears. Goldman Sachs projects prices could climb to 3,700 to 4,800 by mid-2026 amid economic uncertainty. However, easing trade sanctions and stronger US dollar have recently tempered gold's appeal as a safe haven. For silver, up about 12% in 2025, silver lags behind gold due to industrial demand softness and oversupply in sectors like solar. Nonetheless, forecasts suggest silver could reach $34 to $40 per ounce by year end, buoyed by anticipated supply deficits and increased demand from automotive and AI industries. The high gold to silver ratio indicates potential undervaluation, making silver an attractive option for investors seeking higher returns. So we'll start off with silver on the long-term trend first. On the monthly, you can see the price is well strongly above the moving averages, giving us a nice bullish momentum. Likewise, the CCI on the CCI 150 on the chart there is still above the moving averages. So very bullish on the monthly. On the weekly, however, we've got a declining CCI. You can see it started back here. We had a bearish divergence on the highs on the CCI, lower highs versus higher highs on the price. That actually broke down, hit our 23-38% target range. And what we do with that is we draw a Fibonacci from that peak to measure that drop, and we take it back to a significant low. So that would have been probably that area there. It would have been the first point to note, and then we take it back. So I typically take it back to the low before that divergence started. So that would have been the ideal place to put it, as a 23%. You can see it's hit it quite easily. Even at that point, it's broken below the 23% and then bounced. Even to that point, it still hit that range, and even to that point there, it still hit that 23% range. So take it back to the significant low is the idea on divergence. But at the moment, you'll notice the CCI is still broken below and still dropping, and the price is pretty much consolidating. So it's a bit uncertain on the price at the moment, but the CCI is showing us a weakness. So just be cautious about going long. I wouldn't be going long at this point. On the daily, likewise, we had another bearish divergence here, a smaller time frame divergence, bearish divergence, and actually dropped quite strongly and went well below the 100% retrace level, even below that point there. Bounced off that minor support at 28.31, and it bounced. Now since then it's actually broken higher above the moving averages, but notice that moving average on the price was still declining. It weakened, hit that resistance, and it's dropped now on the CCI below the moving averages, and looks like the price may drop below those moving averages as well. So somewhat bearish on the daily. If we go to the intraday chart, the 1 hour chart, and again taking predominantly short trades if you're trading on the intraday, and you can see here, there's currently, that would have been a bearish divergence as well. Double top on the price versus lower highs on the CCI, and that actually broke down as well. And that's still in decline. You can see there the price is below the moving averages. The CCI is a fresh breakout to the downside. So taking short trades only. And that's also supported by the declining daily CCI as well. Now what I've got here is the back test, and I'm showing you here the going long trading, and this is I'm not suggesting you go long. I'm just showing you how the trading works. So you would have taken long positions when the price and the CCI broke above the moving averages on the daily, and that's where these periods start, on the stop loss approach and the average down approach, and you would have taken some little trades here. And ideally you would have closed out the trades when that CCI came close to entering that moving average band. You can wait till it breaks into that moving average band, but just to be safe, you can actually take your profits off the table as soon as it comes and almost kisses that moving average on the daily. That's where you take the stop trading on the 1 hour time frame, and that would have closed out your positions around that point there. Now you'll notice the stop loss approach is broken below the break even of 100,000, and I use that 100,000. I'm not suggesting you need 100,000 to trade. I'm just using that as a potential area as a back test. If I'm trading also, say for example, Japanese yen, it does trade in the hundreds or tens of thousands of units. So here we've got the stop loss approach did okay initially when the price was rising, but then started declining once the price started consolidating and dropping off. The average down approach here has averaged down a few times there in those little trades there, and at that point it started paying dividends. Now, as I said, you would have closed it out at that point there when it almost touched the moving average band, or even at that point afterwards. Even so, you can see at that point there, had you closed it out, that was returning 13,845 versus the stop loss approach generating or losing about close to $2,000, almost 1,500. So I'm not telling you to do the average down approach. It's a pretty risky area, but you've got to be very, very strict with your rules. So just be careful about that. The traditional stop loss approach only works when the price goes in your favor, such as in this period back here. So now looking at gold, which have a similar pattern. It's a very strong bullish momentum on the monthly chart. Although notice this month so far, I've got a small bearish candle. No CCI forward drawn on the monthly, but showing bullish momentum on the monthly price chart. On the weekly, you can see there it's made lower highs on the CCI versus higher highs on the price. Now, since our last update, that's actually risen slightly. Doesn't make a huge difference in terms of the divergence. So again, if we're going to project a decline, assuming it starts pulling back from there, we expect it to reach this area here, the 38% range. That's pulling it back to that low before that divergence started. So I'll keep that in there for the moment. That's assuming it starts pulling back from there. Remember, I don't trade these divergence. I use them as a potential area to get out if you're, in this case, if you're going long. As soon as you see the first divergence, and the first one would have been probably that peak there. Let me just draw it for you. So higher highs on the price and lower highs on the CCI. That was your first indication of a bearish divergence, and I've already drawn a target area for that. You can see the 38% range, and that was drawn back to that low. That's already been hit, then it bounced out of there. So the way you trade that is only trade in direction. So here it started breaking higher, and you would have taken some long trades probably from that area there when the price is above the moving average, and so was the CCI. So that's the weekly showing a bearish divergence. I'd be cautious about going long at this point. It may well come back and hit this range. On the daily, likewise, we had this on our last video. It's risen slightly since our last video on the price, but also the CCI. That CCI is almost a double top and still considered a bearish divergence versus higher highs on the price. And again, you can see there the CCI is already broken below the moving averages, and the price is broken into that moving average range. So giving us a somewhat, I would call it a bearish move at the moment on the daily. Now on the 1 hour time frame, again, we had another bearish divergence here. Now this one failed because you can see there if it drew that was almost a double top there to that point there. If I was to extend that, that's a double top on the CCI versus higher highs on the price at that point, but that didn't retrace at that level. So that's a failed bearish divergence. They don't always work, but more than 90% of the time they do work. So for example, if we were to draw that to that level there, strictly speaking, yes, that is a higher high on the price, but that's also a higher high on the CCI. So we're going to invalidate that divergence and we don't focus on it. Now in this case, that actually pulled back similar to what a divergence would have done. But again, I'm not going to take credit for that because that was technically not a bearish divergence. Nonetheless, it has actually broken down. And if we take it back to that significant low, you can see it's broken down and bounced off that 38% range a couple of times. And now it's finally fallen further and approaching the 50% level. So taking short trades only. So what I have here now, the back test for going short on gold. And that's because the CCI here is broken below the moving averages. Now this is a bit premature in terms of these back tests because notice the price is still above the moving average. So still somewhat, the moving averages are somewhat bullish. That price could actually bounce out of there. Okay, so just be very careful about this. I prefer to see the moving averages bend down as well as the CCI being in a decline as well. So you can see here, that broke below, it's still moving up, but then the moving averages broke to the downside. Now that would have been a bit too late to enter possibly, but that's the price you pay, I suppose, to be more cautious. I prefer to see the moving averages and the CCI on the price and the moving and the CCI going in the same direction like this. That would have been ideal to go long during that period. Another little long positioning there. Anyway, the back test here, the stop loss approach and the average down. I've started the back test here to at that point when it broke below, just to show you demonstrate how that works. So again, the stop loss approach, that in this case generated some nice little revenue, about $780, $790 on the stop loss approach. And again, remember the entry is when the price and the CCI break below the moving averages. That's where you enter the trades. And the stop loss approach, you take profit when it hits 3%. Likewise, the average down approach, take profit when it hits 3%. And the stop loss, you close a position when it hits a 5% loss. Now, in this case, it had a couple of little losses there, but nothing too dramatic. And more recently, it gave you a few more returns. The average down approach, you don't stop loss it at 5%. Instead, when the price drops by more than 5% and the entry parameters are met again, then you enter another position. In this case, it averaged down, had a bit of a drawdown there. It went pretty much sideways for a while. You can see the price going was also pretty much sideways until it started paying a dividend when the price dropped off. So again, be very careful about the average down approach. Have some strict rules when you apply that, and you ideally probably shouldn't have been trading when it was going above the moving averages here. So if you're new to trading, we're now including a weekly video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. And if you enjoy the content, help keep me motivated, why not subscribe to the Patreon page for a cost of a coffee each month. That's where we look at and publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.